Ben Reppond. Welcome to my YouTube broadcast. Today is February 26, 2025. I'm going to begin with the dashboards. This last week was mixed, but it was probably more negative than positive. And it was more negative than positive. So we are, February so far is moving in the direction of negative, and year to date, the returns that were positive are now starting to come down, and of course it's becoming more defensive. So there's a lot to report here. So I'm going to begin with the stock market indexes. These are the 4 U.S. indexes: Dow, S&P, NASDAQ, Russell, and the 2 foreign indexes, the EFA, which is the developed markets, and EEM, which is the emerging markets, and then long-term government bonds. The combination of what is doing well and what is not doing well is a pattern I have not ever seen before. It probably has happened, but since I've been doing this, I haven't seen it. So I'll begin with that. In the yellow box is the different indexes and which ones are positive and which ones are negative. A couple of positive and the others are negative. And then in the pink box is the year-to-date numbers. Now, what's interesting, and these are ranked based on the year-to-date numbers. Take a look at this. EFA on top, that's foreign developed markets, mostly Europe and Japan. EEM, developing, underdeveloped markets, ranked number 2. Number 3, NASDAQ. Long-term government bonds came up off the bottom, and it's now ranked 4th. And then the S&P and Dow, and no surprise, the Russell 2000. But with the S&P and Dow ranked at number 5 and number 6, and the emerging and developed markets ranked 1 and 2, wow, that's amazing. So you can see on the very far right, the red dots, green dots, there are 17 green dots, showing that they're above their 20, 50, 100, and 200-day moving averages, and then the red dots mean they're below that. The positive in this year-to-date number, look at the developed markets, up 7%, and the emerging markets up 7%, and you drop all the way down to the U.S. markets, and those go into the 2% category. Pretty big gap there. So it's showing really the U.S. is out of favor with other parts of the world markets. The sectors, there are 11 sectors, and these are 11 of them. They are part of the S&P 500. So instead of just getting one number for the S&P, we break it down into the 11 component parts. The yellow box shows which ones are negative and which are positive. 3 of them are barely positive, and the other 8 are negative for the last week. Year to date, you can see in the pink box, again, most of them are positive, and a couple of them are negative. To the right, you can see which ones are above or below the 20, 50, 100, and 200-day moving averages. But when you look at that 20-day, look at how many of those are negative. So there are 7 of them, I guess, that are negative, and 4 that are positive. Here's the line chart for the S&P 500 for the last 2.5 years. Pretty much, it's not straight. I straightened it out with a black arrow, but the trend line is definitely in an upward direction, and for a long period, not all of it, but for a long period, it has not broken the trend line, or broken through the 20-period moving average. But you do see the tick down, and you look at the upper right corner of that line, you can see there is a tick down, and that represents last week. When I put this on a candlestick chart, same thing, except you get to see the weeks where it was positive, meaning it's mostly a hollow candlestick, or those that are negative, which is generally represented by a red one. And the last week, you see it was red, and it went down. This is relative strength. NASDAQ 100 compared to the S&P 500. So the S&P 500 contains value stocks, growth stocks, etc. The NASDAQ 100 is part of that. And it went down slightly. So in other words, what this means is that the S&P 500 was stronger than the NASDAQ 100 when it goes down. When we take the S&P apart and look at the value component and the growth component, if it goes down, it favors value. If it goes up, it favors growth. So again, value is coming back into favor because that tick down it's a pretty sharp line down at the far right favors value. The S&P 500 relative to the Russell 2000. So when this goes up, it's favoring the S&P 500. And then when it goes down, it's favoring the Russell 2000 small cap. It went up sharply. So what that tells you is the Russell 2000 small cap index is out of favor relative to the broad market. Long-term government bonds. So they continue to go up in value, which means the yield is going down. So bond yields, I won't quote the 10-year and the 20-year, et cetera, but they have been dropping in the range of about 0.5%. So that's quite a bit for a bond. And as such, what that's done is push up the both the long-term, intermediate-term, and short-term government bonds. Still kind of right below or touching the 20-period moving average. But I put the black line in because you can see the long-term effect of where bonds have gone over that period of time. The dollar continues to weaken. It has over the past month or so, and probably from about the beginning of the year, it has been coming down. But it's still up, and it is trending up and still above its 20-period moving average. Probably the big winner is gold. Gold has, look at that line at the far right of the chart, amazing, going up very nicely. And it's a smoother chart than silver. Silver has also gone up. But this has stayed above the 20-period moving average most of that period of time and is now quite a bit above it. Silver is more erratic. It tends to go up and down more, but you can see to the far right of the chart, not that dissimilar from gold. It's been going up and is clearly now above the 20-period moving average. Bitcoin has been coming down for the past month or so and still above, barely above the 20-period moving average. Volatility index, because the market has gone down, I showed you that, the market's been going down this past week. There's no surprise at the far right of the chart, you can see the volatility index, the VIX, going up. And I didn't put a trend line on this, but it looks to me like it goes up and down, and now it's kind of at the upper end of that range. And it wouldn't surprise me to see this week the volatility index come back down a bit. Last week, Asbury Research had all 6 of its Asbury 6 indicators positive. Because of the negative week that the market had, 5 out of the 6 indicators went negative, and only 1 is positive. This is a relative performance chart comparing one asset to another. So this is an interesting mixture. I don't think I've seen this before. Bonds stronger than stocks. Low volatility stronger than high beta, high volatility. Large cap stronger than small cap. Value stronger than growth. And as I said earlier, emerging markets and developed markets both stronger than the U.S. market. An interesting combination. Here, again, because I've shown you this, the U.S. market is weaker than the international markets. The international markets, using the stock market, not the currency or the economy, but the market, the following countries are stronger for the last quarter, week, month, and quarter. They are Chile, Mexico, Switzerland, Italy, Germany, Spain, France, the UK, the entire Eurozone, Malaysia, Japan, Hong Kong, Singapore, Taiwan, South Korea, China, the entire Pacific, and Saudi Arabia. So you can see it's very Europe and Far East, it emphasizes those being stronger than the U.S. And then the ones where the U.S. is stronger is New Zealand and Australia. This is where I've used putting the U.S. versus South Korea because it's a longer term, not a lot of up and down, but if there is, it's in a trending mode. But you can see in the last month or so, maybe the last couple of months, where the U.S. market relative to the South Korean market has come down. So if you were to invert that, you would say that's the degree to which South Korea is actually outperforming the U.S. market. Gold and silver, as I said, you can see it on that chart that the last several weeks, maybe a couple of months, gold and silver have been going up. This last week, gold is up 1.9% over the previous week. This is as of Friday the 21st compared to Friday the 14th. Silver, and the price is spot price, $29.37, almost getting up there to the $3,000 level. Silver, $32.84, up 1.2%, and still maintaining a gold-silver ratio of 89-1. A monster box of silver is $16,895. That includes the markup. So in this example, the markup is $1.05. That's a pretty low markup if you've been tracking it over a period of time. This is for silver. So I remember seeing, when was it, 2021, so this would be over 3 years ago. I think that's correct. Silver, the markup on silver was around $5, sometimes even more. And silver eagles got up to as high, believe it or not, markup of $10 to $15 per ounce. Crazy. But it's come way down, and it's got down to $1.05. Now, my son Preston is in the precious metal business, and I asked him, what's the cause of this? Is it supply and demand? On the markup, yes. On the price, not so much. On the price, that's, I hate to say it, but it's manipulated. But the markup, what $1.05 tells you is that people do not have the money to buy as much as they used to. So it's softening, showing up in the markup. And that brings the price per round using $1.05. Each retailer chooses their own level of markup, but if you use the $1.05, that's $33.79 per round when doing it with a box of 500. Okay, thank you for watching. Please hit the subscribe button if you're not already a subscriber, and if you have comments or questions, leave them in the comment section below.